Have you ever wondered how investing works? Well, all about putting your resources, often money, to work with the aim of creating more wealth over time. It's like planting a seed today, nurturing it, and then reaping the fruits tomorrow. There's a wide variety of investment vehicles you can choose from. Stocks, for instance, are shares of ownership in a company. You profit when the company's value rises or when they share their profits through dividends. Bonds, on the other hand, are like loans you give to companies or governments who in return pay you fixed interest. Then there are mutual funds and exchange-traded funds, or ETFs, where you pool your money with other investors to buy a diversified set of stocks or bonds. If you're into property, real estate investment is another option. And let's not forget cryptocurrencies, the digital currencies that have taken the world by storm. If you find this, now that you're familiar with the basics, let's delve into how you can start your investment journey. Before you start investing, first, you need to define your investment goals. Why, you may ask? Well, your investment goals act as your compass, guiding your investment decisions and strategies. Your goals could be anything from saving for retirement, a down payment on a house, your child's college fund, or simply building an emergency fund. The beauty of setting clear investment goals is that it grants you the power of clarity. It helps you understand what you're aiming to achieve, how much risk you're comfortable with, and the time frame you're working within. For instance, if you're saving for retirement that's 30 years away, you might be more comfortable taking on higher risk investments like stocks or cryptocurrencies. Conversely, if you're saving for a down payment on a house in 5 years, you might opt for lower risk investments like bonds or mutual funds. With clear goals in mind, the next step is to arm yourself with knowledge. Knowledge is power, especially when it comes to investing. The world of investments can be a labyrinth full of twists, turns, and unfamiliar language. But don't be daunted. With a little dedication, you can navigate this maze and make informed decisions that align with your financial goals. So how does one educate themselves about investing? There are a plethora of resources available to help you understand the dynamics of the market, the variety of investment vehicles, and the art of risk management. Start with online resources. Websites like Investopedia and Morningstar offer a wealth of information, from the basics of investing to the complexities of financial markets. They provide articles, tutorials, and glossaries to help decode the jargon and concepts of the investing world. Financial blogs, too, can be a treasure trove of knowledge. They offer real-world insights and experiences from seasoned investors, finance professionals, and even fellow beginners. You'll find practical tips, investment strategies, and opinions on market trends. Books and courses can also be invaluable. Look for recommendations from trusted financial experts or successful investors. They can provide in-depth knowledge and a more structured approach to your learning. Remember, it's not just about understanding how different investment vehicles work. It's also about keeping up with market trends. The financial market is a living, breathing entity that changes constantly. Regularly reading financial news can help you understand these shifts and how they might impact your investments. And let's not forget risk management. Understanding risk is a fundamental part of investing. Each vehicle carries a different level of risk and potential return. Balancing these two factors is key to a successful investment strategy. In the end, it's about equipping yourself with the knowledge to make informed decisions. Investing isn't a get-rich-quick scheme. It's a journey that requires understanding, patience, and a willingness to learn. So roll up your sleeves and dive into the wealth of knowledge available. The more you learn, the more confident you'll become in your investing journey. Equipped with knowledge, you're now ready to choose your investment platform. Before we proceed to choosing your investment platform, let's take a brief detour. If you're interested in creating and operating a YouTube channel from scratch, we have an exciting opportunity for you. Introducing the YouTube Mastery and Monetization course. This comprehensive course is specifically designed to guide you step by step in not only creating your YouTube channel, but also in effectively managing and monetizing it. From understanding the YouTube algorithm to optimizing your videos for higher visibility, from gaining subscribers to creating engaging content, this course covers it all. It's designed for beginners and experienced YouTubers alike, offering insights and strategies that can help you maximize your channel's potential. The best part? You can learn at your own pace. with access to a wealth of resources and experienced instructors. Interested in the course? You can find more information about the YouTube Mastery and Monetization course in the description below this video. Don't miss this opportunity to master YouTube and monetize your content. Now back to our main topic. Let's talk about choosing the right investment platform. Choosing the right platform is a crucial step in your investment journey. Just as a chef needs the right kitchen to prepare a meal, an investor needs the right platform to make sound investments. When you're deciding on an online broker or investment platform, there are a few factors you should consider. One of the first things to look at is the fees. Some platforms charge per trade, while others may have a flat monthly rate. Make sure you understand how these fees can affect your returns, especially if you're starting with a smaller investment. Next, consider the available investment options. Some platforms offer a wide range of assets, including stocks, bonds, ETFs, mutual funds, and even cryptocurrencies. Choose a platform that provides the type of investments that align with your goals and risk tolerance. The user interface is another important factor. You want a platform that's easy to navigate with clear, easy-to-understand information. Look for platforms with intuitive interfaces that make it easy to buy and sell, monitor your portfolio, and access research tools. Customer support is also key. When you're investing, time is money. If you have a problem or question, you want to be able to get help quickly. Look for platforms with strong customer service, whether it's through live chat, email, or over the phone. Lastly, consider the educational resources a platform offers. Especially for beginner investors, having access to tutorials, webinars, articles, and other learning materials can be invaluable. Now let's talk about some popular platforms. Robinhood, for instance, is known for its user-friendly interface and zero-commission trades. E*Trade offers a wide range of investments and has excellent research and educational tools. TD Ameritrade is renowned for its customer service and comprehensive educational resources. And Fidelity offers a mix of low-cost investments, robust research tools, and top-notch customer service. Every platform has its strengths and weaknesses, and what works best for you will depend on your personal needs and investment goals. So do your research, weigh your options, and choose wisely. Now that you've chosen your platform, it's time to start investing. It's time to make your first investment. Starting small is a wise strategy for beginning investors. This means investing an amount you're comfortable with and can afford to lose. Think of it as dipping your toes in the water before diving in. You get a feel for the market, learn from your experiences, and build confidence without risking a significant portion of your wealth. Now let's talk about diversification. Picture yourself at an all-you-can-eat. Would you fill your plate with just one type of food? Probably not. Just as you'd want a variety of foods to balance your meal, diversification helps balance your investment portfolio. By spreading your investments across different asset classes like stocks, bonds, and real estate, you reduce the risk that comes from relying on a single investment. Exchange-traded funds or ETFs and mutual funds can be great starting points for diversification. These funds pool money from multiple investors to buy a variety of assets. Essentially, they offer a ready-made diversified portfolio. When you buy shares in these funds, you're getting a slice of this diverse pie. Plus, they're managed by professionals who have the knowledge and experience to make informed investment decisions. But diversification isn't just about reducing risk. It's also about aligning with your risk tolerance, your ability to endure potential financial loss. This will vary from to person, and it's important to be honest with yourself. If the thought of losing a small portion of your investment keeps you up at night, you might have a low risk tolerance and should lean towards more conservative investments. And remember, investing isn't just about making money. It's also about preserving your wealth. So don't invest money you can't afford to lose. Instead, consider it as part of your budget, like a monthly bill payment. Only this one has the potential to grow over time. Don't forget to subscribe and hit that notification bell to keep updated with more valuable content. You've made your first investment, but remember, investing is not a set-it-and-forget-it activity. A successful investor keeps a close eye on their investments. Regular monitoring is not about obsessing over daily ups and downs, but ensuring that your investment portfolio continues to align with your goals as well as adapting to market changes. Just as a gardener prunes a tree or adjusts a ship's course, you should be prepared to make tweaks to your investments when necessary. Maybe your life circumstances have changed, or a particular asset class is under or overperforming. But here's a word of caution. Be wary of making hasty decisions based on the market. It's easy to be swayed by the latest headlines or chatter around the water cooler. Remember, investing isn't about chasing the hottest trends or reacting to every market blip. It's about creating a thoughtful strategy and sticking to it over the long haul. Remember, investing is a journey. Stay informed, stay patient, and stay on course. Investing always involves some level of risk. It's like a seesaw. The higher you go with potential returns, the higher the risk you must be willing to bear. This is why understanding and managing risk is an essential part of the investment puzzle. Think of risk as the level of uncertainty that your investments will achieve their expected returns. No one likes uncertainty, right? But here's the it's and parcel of investing. It's this uncertainty that gives investments like stocks their high return potential. Now, how do you manage this risk? You do it by determining your risk tolerance. This is based on your financial situation, investment goals, and how comfortable you are with the market's volatility. Are you a daredevil, ready to ride the roller coaster of high-risk investments? Or are you more of a player, preferring the steady climb of lower-risk options? With the right knowledge, goals, and risk management, you're well equipped to embark on your investment journey. Stick around to view other videos offering more valuable content.